Hi everybody, Brian Matthey from Verico the Mortgage Professionals in Kingston, Ontario, and welcome to another edition of Mortgage Straight Talk. I've been in the mortgage business for over 24 years. In fact, when I started in 1989, interest rates were 12%. Now I know many of you may not remember that, your parents may, and that's because I'm a little bit of an old guy in this industry. But today, interest rates are at historic lows. My clients' questions to me over those last 24 years have not changed. Do I take fixed? Do I take variable? If I'm taking fixed rates, do I go long-term or short-term? And for variable clients, is it time to lock in? Well, personal situation and risk has dictated that choice in the past for borrowers, and today is no different, but the landscape has changed dramatically. Nobody can really forecast where interest rates are going, but history has taught us a few lessons. Number one, rates go up faster than they go down and can go up quickly in response to changing economic conditions. Number two, prime rate and fixed rate mortgages can move in different directions. And number three, good economic news is bad for interest rates and bad news is good news. Let's get started. The graph you see before you is self-explanatory. It shows the trend of 1, 3, 5, and 10-year mortgage rates from 2006 to the end of 2012. We'll be focusing on the 5 and 10-year terms, which are the top two lines in the graph. From 2006 to 2008, many clients locked into a 5-year fixed mortgage. In fact, the industry average over the last 5 years has been that 66% of borrowers chose a 5-year term. Interestingly, less than 1% of people chose a 10-year term in that same time frame. In 2009, in response to the credit crisis and a recession, 5-year rates bottomed out for the first time, and prime went from 6% to a historic low of 2.25%, while fixed rates went down to 3.69%. Some borrowers in 2009 still chose 5-year fixed terms, but about 70% of my clients bucked the national average and took a variable rate mortgage for three reasons. One, they thought fixed rates were still going to move lower. Number two, they could save over 2% in a discounted variable rate compared to the current fixed rate. And number three, they had a good mortgage broker keeping them up to date on what was happening in the interest rate market. From 2010 to 2011, fixed rates bounced around to a high of 4.29 to a low of 3.15, while variable rates continued to be low, increasing by only 3/4 of a point to the current rate of 3%. In 2012, rates bottomed out to the lowest in history, and this is where the landscape changed significantly. In 2012, 70% of my clients chose a 10-year fixed rate because they had witnessed the high rates in the past. Number two, there was little difference in rate between a 5-year term and a 10-year term. And number three, variable discounts had all but disappeared, leaving little advantage in variable rates versus fixed. The story of the economic recovery is the story that's going to determine where interest rates are going to go in the future. All eyes are on the recovery in Europe and in the US and how that will impact us. And can we say rates will go up? Well, yes, we can. Eventually. The graph really shows we only have one way to go, and we do know that rates go up faster than they go down in response to economic conditions and good economic news. Variable rate clients can expect to see rates stay flat for the first half of the year, but they have to ensure that they don't miss the bottom of the market. You may risk short-term gain for long-term pain. If you're renewing in 2013, you need to consider your options now while rates are low, and first-time buyers should consider securing their future with the lowest rates in history, whether they're choosing a 5 or a 10-year term. If you're renewing in 2014, you may want to consider an early renewal. In my next video, I will be discussing the 5 and 10-year term mortgages, the pros and cons, and their impact on you and your future. Hope you enjoyed today's session of Mortgage Straight Talk. Thanks for watching, and talk to you soon.